today I'm going to start a very new and interesting topic, disclosures in annual report of a company. Because when we go for accounting for managerial decisions, there is a very pertinent question that how to deal with this reporting aspect of our management accounting. So this is the point where the disclosure is being made in the annual report of a company. This is the place where the directors, or you can say the management of the company, is trying to formally communicate with the stakeholders. Because normally it is said that whatever we do in management accounting, it never goes in public. That is basically being used by the management for the purpose of decision making, and that is why we say that it is a kind of internal accounting. That is one aspect of management accounting. But when we talk about accounting for managerial decisions, we need to understand that directors are supposed to formally communicate with the stakeholders. And when I say stakeholders, I am talking about not only shareholders but also the government, society, employees, the investors, potential investors, and a wide array of people who are actually interested into the performance of the company. So this is going to be part one of disclosures in annual report of a company. I'll be telling you that what is annual report of a company, what kind of disclosures a company is supposed to make, and when we talk about disclosures, it can be mandatory, it can be voluntary. So which disclosures are actually mandatory and which one are voluntary, that is something which we need to understand. Because as a manager, when you join a company and you have to you are provided with the annual report of a company, and you find it so cumbersome, a voluminous report of running into 300 pages or 400 pages is being given to you, and you really find it very difficult to understand what is there into the report. So I'll not only be telling you what are the disclosure which are supposed to be made into the annual report, but I will also tell you the reason why it becomes so cumbersome, why it is running into 400 pages or 300 pages or so. So this is, with this agenda, I am going to tell you what are the disclosure in the annual report. But before that, what is annual report, that we need to understand. Every year, company is supposed to conduct its annual general meeting, and in that meeting they have to actually present their report of their success story or whatever has happened in terms of financial performance of the company, in terms of financial position of the company. Everything is supposed to be reported in that meeting, and in that very meeting, that is annual general meeting, the report which is being submitted, that is called annual report. So annual report of a company, if I have to define, I would say it contains a number of useful reports. It is not only one report. If you actually look at the report in a holistic manner, you will find a series of reports which are actually forming part of annual report. And these report, basically, what is the motive behind providing annual report? The very basic idea is that they are providing you a deep insight into the financial performance and the financial position of the company. So you not only come to know about the profit or loss position of the company, but it also tells you about the financial position, that is what is the liability, what is the position of liability of this company, what is the position of asset of the company, what kind of contracts company has entered into, what is going on in terms of the progress of the company. Apart from financial performance, what was the vision, mission, goal, target of the company, and in what manner, with what philosophy company is actually heading towards the success. So annual report is basically a formal report from which you can get to know about the financial performance of your company. And some of these reports are mandatory in nature. When I say mandatory, it means they are coming from some mandate. Mandate means some enactment. There is some law behind that, and it says that, it stipulates that, it actually mandates, it provides a mandate to the company that you have to actually report these informations in the given format. For certain reports, there is a format prescribed in the enactment. I'll be telling you in due course of our discussion that what are those relevant sections which prescribe for a company to prepare the report in a requisite format, and they are known as mandatory report. Whereas some reports are not at all mandatory, but company feels like reporting it to the stakeholders. They actually want it to inform to their shareholders, to their stakeholders, to their potential investors, that voluntarily we are submitting. For instance, when a company talks about the human resource policy of the company, for instance, when a company talks about the brand equity, for instance, when a company talks about economic value added, or market value added, that is all voluntary, purely voluntary part of their report. But yes, they play a very vital role. That is why company is reporting, the management is reporting these things in their annual report. So broadly speaking, when we have to classify the report, annual report of a company, we can on the basis of disclosures, we can classify them into two parts. One is the mandatory disclosures, another is voluntary disclosures. So for a brief understanding, let's first go ahead with this idea that mandatory means the one which is coming from some mandate, some enactment which is being prescribed in certain laws, and you have to abide by them. So that is why you are calling them mandatory disclosures, whereas some others are purely voluntary. So if we classify it on the basis of the disclosures, on the basis of whether they are mandatory or voluntary, it can be classified into two parts. One is mandatory, another is voluntary. In mandatory, it can be, if I am talking about a company, obviously whatever is required as per the provisions of Companies Act 2013, which is the latest enactment for the companies operating in India. So the provisions which are provided, which are laid down under the Companies Act 2013, whatever they are mandating, whatever they are prescribing, if a company is disclosing according to that, that will form part of mandatory disclosure. Apart from this Companies Act, suppose if we are talking about a company which is not only governed by the Companies Act 2013, but due to its very specific nature, it is regulated by some other enactment also. For instance, if I take banks, if we take banking institutions, they are regulated by Banking Regulation Act 1949. So for them, wherever Banking Regulation Act 1949 is silent, the provisions of Companies Act 2013 shall be applicable. Otherwise, the provisions of Banking Regulation Act 1949 shall be applicable for them, and for them the mandatory disclosure will actually emanate, originate or stem from where? From Banking Regulation Act 1949. Since we are talking about Indian scenario, the annual report of Indian corporate entities, that is why I will be focusing upon the rules and regulations, the laws which are applicable into the Indian scenario. So whatever is required as per Companies Act 2013, this is the first classification, sub-classification of mandatory disclosure. Moving ahead, there are certain disclosures which are required by your accounting regulator. For instance, in India, the Institute of Chartered Accountants of India is actually the regulator of accounting profession. They are actually issuing guidance notes, standards from time to time to ensure the better financial reporting of the companies. So whatever is required as on date, if you ask me, I would say that it is INAS, which is the Indian name for IFRS, Indian answer to the IFRS, that is International Financial Reporting Standards. So INAS also prescribes certain ways of disclosures, that is also part of your mandatory disclosure. So over and above the provisions of Companies Act 2013, we do have certain regulations by accounting regulator. For instance, ICAI prescribes disclosure as per Ind AS, so that is something which company has to comply with. Apart from that, suppose if I am talking about a company which is listed into a stock exchange, so there is a requirement for the companies to disclose certain aspect of their financial performance, their financial position, their dealings, their transactions as per LODR. We call it listing obligation and disclosure requirement. So there is a clause 49 of listing agreement which is prescribed by the Security and Exchange Board of India, SEBI, which is the regulator of capital market in India. So the Clause 49 also stipulates those agreements, those LODRs, listing obligation and disclosure requirement, and those requirements are supposed to be complied with by the companies which are actually listed into any of the stock exchanges operating in India. So when we talk about mandatory disclosure, we have to just remember that suppose if I am talking about a company, whatever enactment, whatever is the law of land, we have to actually abide by that, we have to comply with that, and when we comply with that in terms of our disclosures in the annual report, they are known as mandatory disclosures. So the mandatory disclosure is basically the integral part of our annual report, where we cannot make much of change, whether it is in terms of format or whether it is in terms of ignoring them or considering them. You don't have choice, but you have to actually provide these informations, you have to actually disclose these informations into your annual report. So it is something which is compulsory, which is mandatory for you as a company to disclose. That is why we classify them as mandatory disclosures. Whereas when we look at the voluntary disclosures, the term itself is indicating it is your choice. Here you have a choice of not only deciding the disclosure aspect of it, whether I should disclose it or not, I should disclose this information or not, but also about the format. You have the freedom to choose the format in which you have to provide the voluntary disclosures. So it is something which is decided by the company whether they feel like disclosing these informations in their annual report or not, and if they feel like reporting, they report, otherwise they may choose to skip it. And here we can have number of disclosures depending upon the type of company, but I'll be just telling you the most common voluntary disclosures. For instance, human resource accounting. Some companies, they are going for human resource accounting, that they are considering their human resources to be a capital. They calculate their cost of acquiring human resources, their training cost, and then whatever gains they are having. So they are doing this kind of accounting just to offer greater importance to their human capital, human resources, and there they are disclosing their human resource accounting. Some companies, they do disclose about their brand equity. They tell that this is my brand equity, this is the value of my brand. So in due course of time, when a brand gains a huge market acceptance, so it becomes an equity for the company. And at times in the corporate interview, it is being asked to you, where do we show brand equity in the company's annual report? So you can tell frankly that it is under voluntary disclosures. There is no such format for it, there is no legal requirement for it, but yes, companies do disclose such kind of informations in their annual report, and it is a kind of value addition to the performance of the company, to the image of the company, to the brand equity of the company. Then comes EVA and MVA. What is economic value added and what is market value added? It is something which is part of your financial management, that what is my economic value added. Financial accounting says, the standard says that you have to disclose your profitability, you have to disclose your financial performance, whether you made a profit or you incurred loss, or whatever is your financial position, that is something which you have to report. But EVA is something which tells you that what is your net economic value addition, what is your it is over and above your the cost of, after deducting your cost of financing, whatever you are adding to the capital base, whatever is being added to your capital, that is called economic value added. And market value added, of course, if you feel like disclosing, you will be disclosing. So this is a brief you can say flow chart to understand this. This gives you an idea what is there into the annual report of a company, because at times students are finding it difficult to go through a report. When we are offering them a report, they feel that sir, how to read this annual report? We have to make a decision as an investor. So which part of annual report am I supposed to go through? So if you understand the entire the skeleton of this annual report, the entire flow of this annual report, it is quite easy for you to identify what are the statutory reports, what are the mandatory reports, and what are the voluntary disclosures. So accordingly you can go to the relevant disclosure, you can acquire the information, you can get to know about the financial performance of the company or financial position of the company, and accordingly you can make a decision. When we talk about another classification apart from mandatory and voluntary disclosure, there is another classification that is based on what type of company you are. Are you a listed company, or you are a private and unlisted company where you don't feel like going into the public, you are not going for issuing shares or debentures, you are going ahead, you are running your business with your private placements, with your own capital. Then in that case, what should be there into the annual report of your company? So remember, when we talk about listed company, the term listed itself indicates that your company is listed in one of the stock exchanges of India, that is our country. So as per LODR requirements, regulation 32, 34 and schedule 5 of LODR regulations, they actually mandate companies to provide certain informations, which I'll be telling you in due course of our discussion. that what are those disclosure under regulation 32, 34 and clause 49 of listing agreement, what is there, what is there to be provided by the company in their annual report when you are a listed company, that I'll be telling you. Apart from that, for listed companies under section 134, and there are other provisions also under the Companies Act 2013 with relevant rules. They are supposed to be read with the relevant rules, so that the proper disclosure should be there in the annual report. But when we talk about private and unlisted public company, obviously the rules are not that stringent, because you are not making use of public's money. You are not you are going ahead with the capital of your own. So section 134, again it is providing certain provisions which are supposed to be read with relevant rules, and accordingly they have to disclose the information in their annual report. But yes, of course, that report is not that cumbersome. When you are talking about a private and unlisted public company, then obviously the report doesn't require, there is waiver, there is exemption of certain disclosures which are specifically mentioned for listed companies. So from those disclosures we are having a relief. Now I'll be moving ahead gradually. I'll first start with the mandatory disclosure, and under the mandatory disclosure I'll first tell you what are the disclosures required under the provisions of Companies Act 2013, starting with the first and the most comprehensive enactment for regulating the companies which are operating in India, that is Companies Act 2013. So what are those regulations that I'll be telling you? Remember, any company which is registered in India, if you are a company which is incorporated in India, you are supposed to be regulated in terms of the provisions of the Companies Act 2013. Prior to this Companies Act 2013, we used to have Companies Act 1956, but after this amendment, we got a new enactment called Companies Act 2013. So any company which is being registered in India, which is operating in India, it has to be governed as per the provisions of Companies Act 2013. This is for sure. Second is, this act, as an enactment, it requires a number of disclosures to be incorporated in the annual report of a company. It actually prescribes, it actually instructs the companies that you have to disclose, certain things into your annual report. When you are publishing your annual report, when you are going to the, your stakeholders and the report which you are presenting in the annual general meeting of your company, that is AGM, you have to, provide certain disclosures, and that list is provided, under different sections, rules and regulations of Companies Act 2013. And remember, these disclosures are applicable to all companies, and they are mandatory in nature. Why they are mandatory? Because they are coming from a mandate. When we talk about Companies Act, it is an enactment which prescribes certain rules and regulations. And what if a company doesn't follow? If a company doesn't follow, there are penal provisions also. So actions may also be taken against the company which is not following these provisions. That's why we are saying it is mandatory. These are mandatory disclosures. Now, when we talk about disclosures under the Companies Act 2013, it can broadly be, grouped under three reports. First is Auditors Report, second is Directors Report, and third is you have to offer details regarding subsidiary companies. So I'll be telling you one after the other, what is Auditors Report, what is Directors Report, what are the details regarding subsidiary companies. Before that, you need to understand what is subsidiary company, what is holding company. So in brief, I'll be telling you. I'll not be, going into the intricacies of sections, subsections, although I'll be telling you what are those sections, subsections, clauses, subclauses, that I'll be telling you. But my focus will be, to clarify, to provide you a basic idea what is there into the annual report of a company in terms of classification, and what is the rationale behind prescribing such reports as mandatory reports under the provisions of Companies Act 2013. So Auditors Report, Directors Report, and details regarding subsidiary companies, these are three reports which are basically prescribed as per provisions of Companies Act 2013. So let us start with the Auditors Report. Auditor, we all know, the person who is doing the audit of the company. They are actually, after your financial statements are ready, your accounts are being finalized, there is an auditor who is going to audit your books of accounts or books of records. So the accounts of the company, they are required to be audited by an external auditor. When I say external auditor, I mean to indicate towards an auditor who is actually not acting as an employee of your company. So this person has to be an external auditor, and as per the provisions of Companies Act, such an auditor is also called as a statutory auditor, and the audit which is being conducted by such auditor is known as statutory audit. And since it is being done by an independent auditor, we also call it independent audit. So there are three names to this audit: statutory audit, independent audit, and external audit. These three are the same. It is statutory because Companies Act 2013 prescribes for it. Second is, it is independent because the person who is conducting or performing this audit is not an employee of your company. The person is supposed to be independent so that he or she may form his or her opinion about the financial performance and financial position of the company, whether it is presenting true and fair picture of the company's performance or not. Third is, since they are external to the company, that is why we call them external audit. So either you call it statutory audit, or you call it independent audit, or you call it external audit, they stand for the same thing, the same process, that is audit. Now that auditor is supposed to provide his or her report, and that report, my dear learners, that is supposed to be presented in the annual general meeting of the company. This statutory audit is performed by a person who is a practicing chartered accountant. When I say practicing chartered accountant, I mean to indicate towards a chartered accountant who has obtained certificate of practice, which is known as COP, from the regulator, that is the Institute of Chartered Accountants of India. So the person who is a fellow member of ICAI, that is having a valid certificate of practice, can perform statutory audit of a company. And auditor's report, when we talk about the auditor after performing his audit process based on their audit, auditors are, they are supposed to make a report to the shareholders of the company. Now this is very important for you to understand. Auditor's report is being addressed to whom? Whether it is addressed to directors or to the shareholders or to the company, it is actually addressed to the person who has appointed. So shareholders are regarded as the real owners of the company. So they are basically, their prime liability is towards shareholders. So they have to address their report to the shareholders of the company. They are addressing to the shareholders of the company that based on their audit, whatever opinion they could form, they will actually be reporting. Now the question comes, under which section of Companies Act this audit is being performed? So there is a section 143 subsection 2. I am repeating it, section 143 subsection 2 of Companies Act stipulates that the auditors are required to state in their report their opinion on the accounts audited by them. So whatever report the auditor is preparing, as per section 143 subsection 2 of the Companies Act 2013, they have to state their opinion whether the profit and loss account is presenting true and fair picture of the financial performance of the company, and balance sheet is presenting true and fair picture of financial position of the company or not. So if it is presenting, then too they will be giving their opinion. If it is not presenting, then too they will be giving their opinion. And there can be a different way of reporting to the shareholders, that I will be telling you in due course of time, when they go for issuing adverse report, when they are going for having qualified report, when they are going for having a disclaimer. So what is the difference between clean report, disclaimer, then adverse report and qualified report? That you need to understand. So auditor's report is addressed to the members of the company, which are shareholders of the company, and it is required to be read out in the annual general meeting of the company. So whenever the AGM is being held, all the shareholders are given due invitation and they are supposed to be present. So the shareholders who are present in the annual general meeting, in front of them the auditor's report is being read. So they have to, it has to be read out in the annual general meeting of the company, so that the shareholders must know what auditors speak about the financial performance of the company. It's not only the accountant, it's not only the directors who are reporting the financial records, that is financial profit and loss account and balance sheet. So books of accounts are there, but apart from that, balance sheet and profit and loss account is being presented. Apart from that, what is most important is the auditor's report, which is being read out in the annual general meeting of the company, in which shareholders are supposed to be present. And remember, if the opinion of auditor is affirmative, that is positive, then obviously auditor report is said to be a clean report. So if auditor finds everything in order, if auditor feels that profit and loss account is showing true and fair picture of profitability and balance sheet is showing true and fair picture about financial performance, then auditor may issue a clean report that in my opinion everything is okay. That is called clean report. But what if the auditor is not happy? So in extreme cases, it rarely happens, because normally accountants, those who are performing the accounting work, they are also from the accounting background, they do understand the rules and regulations. But in an extreme case, what happens if on the basis of information provided to the auditors, the auditors are not able to form some opinion, they may issue a disclaimer. First of all, they will be demanding for those informations that, see, with this information, with the information available provided to us, we are not able to form any opinion, so kindly provide. But suppose after making a request to the accounts department, auditors are not able to find requisite information, they may issue a disclaimer. Disclaimer means you are not giving any, you are not in a position to form any opinion. That's why the auditor is giving a disclaimer. Remember, this kind of instances are very rare, but suppose if it is there, auditors are supposed to report to the shareholders that, see, your accounting department, accounts department could not provide requisite information so as to enable us to form an opinion. That's why we are issuing a disclaimer. So this is the, after clean report, this is the second step. Suppose if clean report is not clean, there can be a possibility that informations which are provided by the accounts department may be adequate for the auditors to form an opinion, so they may go for issuing a disclaimer. Second level is, suppose if the auditors have got every information from the company, but they are of the opinion that financial statements, they do not represent a true and fair view, then in that case they may issue an adverse opinion, that our opinion is adverse. We cannot call this company, the financial statement and financial position of the company, presenting a true and fair view of financial performance and position. So in that case, they are issuing an adverse opinion. Again, the possibilities is very rare, for an auditor to issue such kind of report. But yes, it can be there. Adverse report can also be there. And if the auditors have any reservation, suppose auditors are of opinion that we cannot say that everything is going wrong. If auditors have some reservation, but such reservations, they do not warrant any kind of disclaimer or an adverse opinion to be given, then in that case, what auditor does? Auditor goes for issuing a report which is called as qualified report. Some students feel that qualified report means the report is better than the clean report. No. Here the qualification is acting as a condition to the report. So it is basically, you can say, after clean report, if we talk about the quality of auditor's report, in terms of positivity, in terms of the positive outlook of auditor towards the financial performance and financial position of the company, you can say after clean report the second level is qualified report. And then comes disclaimer, then adverse report. Obviously adverse report is something which is very negative for a company. So qualified report is saying that everything is going good subject to these conditions, and those conditions are mentioned in the report. So in a qualified report, what auditors do, they actually state that financial statements present a true and fair view of financial performance and position, but subject to these reservations. So your financial statement is showing true and fair position of your company and your profitability, provided these conditions are being clarified, or these reservations or qualifications in the audit report, they are properly taken care of. So that is called qualified report. So the first report which I told you about, the disclosure under the head of Companies Act 2013. So when we talk about mandatory disclosure, the first is Companies Act 2013. Under that, I told you about the auditor's report. Now remaining two reports I'll be discussing with you in the next lecture of mine. I hope you could understand what is there into the annual report of a company, how to interpret the annual report of a company, what kind of disclosures which are mandated into the annual report of the company, I could explain to you. So with this, I'm ending this lecture of mine. Thank you so much.